What happens to your debt during a monetary reset? This is a question I get a lot. There's a lot of people out there talking about a coming debt jubilee, a monetary reset where we'll have a new global currency or a new monetary system put in place, whether it's central bank digital currencies, whether it's Bitcoin, whether it's gold, whether it's a new form of fiat like a treasury dollar instead of the Federal Reserve note that we currently have. And so lots of people wonder, in this day and age where there's a lot of debt, there has to be some sort of deleveraging, some systemic debt reduction. And so what does that mean for you? What does that mean for credit card debt, mortgages, student loans? Do those just get wiped out? How is that treated historically? Usually, obviously, nobody has a crystal ball, but in light of historical events, when these types of things happen, how is debt usually handled, and what might you be able to expect for yourself? Ready? Let's dive in. All right, guys, so the short answer is that technically nothing happens to your debt from a numbers standpoint. Now, the one caveat to that is that we might see some certain forms of debt be erased legally through bills that are passed by Congress. And so politicians have been talking more and more over the last few years about doing something about the student loan crisis, which they actually created, and just by law wiping out all student loan debt. Now, like I said, this is a problem they created because they wanted more students to be able to go to college because of political reasons, and so they started saying government is going to subsidize student loan debt because students are the least creditworthy people out there, right? They've no job, no assets, no history, so why would anybody give them a cheap loan to go to college? And so if you wanted to get a loan to go to college, it was going to be expensive. And so the government stepped in and said, now we'll subsidize it. And so all of a sudden the student loan becomes a federally guaranteed loan. And so banks are chomping at the bit because if the student defaults and can't pay, the federal government is going to pay, right? And so this is guaranteed debt, right? And so they're going to get their return, and so it drops interest rates for student loans, significantly from what they were before. But what that does is it sends a lot of people to college that don't need to go to college or shouldn't go to college or don't, based on merit, might not have gone to college before because maybe their career path would have been different. And so it forces a lot more students into college because it's more affordable, right? When you make something cheaper, the demand, supply and demand, right? And so forces a lot more people into college, which forces a lot more money into college. But this is a slow process, but over time, if you could afford college, before, last semester, and this semester now, I know as a college, I know that you as a student, you're getting free money from the government or you're getting a subsidized loan. Well, I can raise my prices, right? And so as grants and subsidies come out, that forces the cost up. Same thing that happens with healthcare. The more government pours money into healthcare, the more expensive it gets, right? Anything you subsidize grows, anything you tax will decrease. And so it's a fundamental law of fiscal policy. And so this has happened with with universities. They've just gotten more expensive, even though the actual quality of the education has stayed the same or declined, and all that money just goes into ballooning administrative costs at universities. And so you've left a lot of students now where the signal value is really the only thing that a degree signal that provides for you. And so if you don't have a degree now, it's much worse for you. But if you do, you're basically like you would have been with just a high school diploma like 30 years ago. And so it's made life a lot more difficult because now a lot of young people have massive student loan debts, and it didn't actually help out their career prospects, as compared to 30 years ago. And so this has left people wondering, okay, well, before they made this decision to subsidize student loans, trying to think about this future and prevent it, they said, okay, well, we don't want students to just take on a bunch of debt that they don't need just because they can get it. And so we'll make sure that that students are still responsible. We don't create moral hazard by making sure that they can never get out from under this debt, and that you can't get rid of it just by filing for bankruptcy. Otherwise, as soon as everybody graduates from college, they just file bankruptcy. They don't have any assets, they don't lose it. They don't have any income, they're not losing anything. They're just wiping out their debt. And so they thought that was a brilliant plan, but now it's left an entire generation saddled with $1.8 trillion worth of student loans, something like that, something 1.7, $1.8 trillion. And so this is something politicians now are saying, hey, we don't want to admit that we created this mistake, so we're just going to say we're going to provide a solution for this mistake and wipe it out. And so that might be one that makes it through, although it'll piss off a lot of people that spent years paying off their student loans, and instead of just letting them accumulate or just paying off the minimum, people who suffered and went through painful process to get out from underneath that debt. But political solutions are ones that are political. They're not necessarily best for everyone or for the country. And so that might be one that actually legally gets wiped out. Mortgages might be another one, as our economy is very reliant on the housing market and real estate. Mortgages might be one that the Federal Reserve absorbs, and just by law it gets wiped out. So that might be an area of debt. Other than those two, though, I don't expect that there's going to be a massive legalized debt jubilee. And so when people talk about how inflation and hyperinflation and monetary resets wipe out debt, most of that is from the perspective of the affordability of paying it back. And so this is a little bit strange to wrap your head around, but think about your parents or your grandparents who bought a house for $25,000, $50,000. They got a 30-year mortgage on it. That payment today is $75 a month or $50 a month, right? And so in today's dollars, that seems like it's almost nothing, right? It's super easy to pay that small of a mortgage. That's that's your internet bill or your phone bill. But what's hard to imagine is that if you put yourself back 25 years, 30 years, that the pain of paying a $100 per month mortgage is the same as today paying a $1,000 mortgage or a $2,000 mortgage. And obviously it depends on your area and your housing market. And so I'm just using these numbers as kind of a general example to convey the perception of inflation and how hyperinflation wipes out debt, not because it changes the numbers that you owe, because you'll still owe in today's dollars maybe $300,000 on your house or $400,000 on your house. So in numbers, it's not going to change it, but in terms of the ease or the pain of paying that off will be dramatically changed, because what eventually happens after inflation is that wages go up. And you might think, okay, well, yeah, but everything else inflates a lot faster, and wages are one of the last things that gets hit by inflation. You're absolutely right. Wages are the last things to be changed from either inflation or deflation. And that's one of the reasons why deflationary systems make people so much wealthier, because wages don't get cut until, in the time frame of as things get cheaper. Wages don't get cheaper until other things have already gotten cheaper, so people get wealthier over time. Inflation's the opposite, and we all know this. Wages might go up 1 to 3% per year for somebody who's just getting their promotions or their raises, while the cost of living is increasing a lot faster than that, especially the cost of investing. The asset price inflation goes up a lot as well. And so we know this, but it eventually happens, because once you have 30%, 40%, 50%, 60% of your entire population that can't pay the bills, that's when you start having civil unrest. That's when you start having riots. What have we seen this year? Cost of living skyrocketing, money dumping on people, right? And then, a sign of civil unrest. So we see these things start to happen right now. We see these things unfolding. This will continue. And the political pressure that puts on those in power is to dump money on those. And so you do get a wage increase, whether that's from universal basic income actually really in full force being instituted, whether that's from a federally mandated minimum wage being enforced, at a livable wage, which is a moving target, $10 a month, $10 an hour, $15 an hour, $20 an hour, whatever that is. That'll be a moving target, federally mandated minimum wage. Whether that's just welfare starts to balloon and grow, whether it's one-off checks every now and then through, ever increasing and continuing stimulus bills, whatever that looks like, the amount of money that people receive will start to go up. Imagine how much you would have been able to buy 30, 40 years ago by getting a $1,200 stimulus check from the government. You would have been able to buy a heck of a lot more than everybody was able to buy this time around, which was, basically just enough to get by, 1 month's worth of groceries, right? One shopping trip to Costco where you buy 7 things and it costs you $1,000. And so nominally, the actual amount of debts, that's not going to change. But it will become easier and easier and easier and easier to pay off debts that are denominated in the old money, in the current money, the dollar, because as more and more money comes in, it makes the wages, it makes the income coming in will pay those off because, wages, $100,000 is, a year will soon be the poverty level, not something that people think. A lot of people think, as long as I can make $100,000 a year, then I'll know that I've made it. Well, soon $100,000, that's going to be the poverty line. And so if you've got a 30-year mortgage, that's going to look like a very small bill compared to everything else and compared to your income. So nominally, debts don't change. But in real terms, debts do get wiped out because, there's just a lot more money flooding the system. And so you get a deleveraging from that. And even more so if there's a new money that's instituted, a new central bank digital currency that replaces, the dollar, or a treasury dollar that replaces the Federal Reserve notes, or gold or Bitcoin come in and replace fiat as money, then those debts really do get wiped out really fast because they still stay there. You're still going to owe them. You're still going to owe them with the old money, but that old money is going to become so worthless compared to the new money that you can sell a small portion of your new money to buy the old money that will then go to pay off your debts. And so, in the case of gold becoming money, goes up to $25,000 per ounce in order to support, what that would be the price if it was used as a real reserve asset today. That's that's going to crater the value of fiat. And so very easy to take a little bit of that to pay off old debts. Or Bitcoin, if that happens to Bitcoin, it goes up to 400,000, same thing. Or if there's a new money instituted, at that point, the exchange ratio would be, like 1 to 1,000 or 1 to 100,000. Anytime there's a currency collapse and they issue a new currency instead, the exchange ratio is always big like that. And so in order to pay off a mortgage of 300,000, you're going to have millions of dollars. Being a millionaire in the future is not going to be something to be proud of. If you're a millionaire in Zimbabwe today, that's poverty. That's meaningless. That's nothing. They've got trillion dollar notes. And so, if you had a mortgage, in Zimbabwe 30 years ago, that was, $1 million. Well, today you can probably find a couple $1 million in Zimbabwe dollars laying on the street. So that's the same type of thing that I'm talking about here. When currencies collapse, that's what it looks like. Everything just gets more expensive, including wages. And so the money coming into the system makes it really easy to pay off that old debt. So hope that clears some things up for you over the last few months. Gotten a lot of questions about that. Hey, if we do have a currency reset, or if we do have hyperinflation, or a new money comes in, what happens to my old debt? Do I still owe it? Yeah, you still owe it. You still have to pay it off. It just makes it much, much, much easier to pay that debt off. And since we have an entire society and system that's built on debt, the likelihood that the solution that is put in place by those in power will be the likelihood that that solution will attack that debt and make that debt easy to pay off is very, very high. All of the political pressure is on them to make that the solution instead of the opposite, which was actually healthier and better for everybody. But a deflationary deleveraging would be healthier. Probably not going to happen. They're going to do everything in their power to have the inflationary side be the answer. So hope that helps. Your debt you're still going to owe. It's just going to be much easier to pay off in the future than it is today. As always, I really appreciate you guys. And if you've been waiting for my advanced options course to come out, I've been mentioning it recently because I've been getting very close. Next week it is coming out, and so stay tuned for that. It's the best course, most advanced, most in-depth, technical, and simple, straightforward to understand options course available anywhere. And I will let you know it's coming out soon. It's almost ready. So stay tuned, and I'll get that out for you as soon as possible. As always, really appreciate you guys. Have a great day.